Welcome to Investing Ramp, where we explore ways to ramp up our investments. In this video, I'll show you 5 metrics you can use to scan and pick dividend stocks and why I think that dividend growth rate is key metric to compound our investments. Let's jump in. Like and share. First, I look into the 5-year dividend growth rate. Yes, I care a lot about the pace at which company raises its dividend. It gives me ample room to leverage compounding when growing investment income. Let's look at 3 stocks as examples: JNJ, Coca-Cola, and PAYX. Over the past 5 years, these well-known companies have raised their dividends at an average rate of 5%, 4%, and PAYX stepping up its game, growing at 9%. Right off the bat, I see that PAYX is best in growing its dividends. Now let's look at second metric, which is debt to shareholders' equity. This ratio tells me how large long-term debt is relative to company's equity, or value of all shares outstanding. The higher the ratio, the more indebted the company looks to me. Back to 3 examples. JNJ sits at 0.5, Coca-Cola is around 0.8, and PAYX at 0.25, which is surprisingly the lowest among the 3. Now my instinct tells me that PAYX and JNJ are less indebted and probably tap more into issuing new shares instead of high interest rate debt, but to be fair, ratios below 1.0 are mostly fine, especially for a dividend aristocrat like Coca-Cola. Next is payout ratio. In simple terms, is all anticipated dividend payments per share divided by earnings per share. This metric tells me how secure dividend payments are and if company may cut them soon. Generally, I like when the ratio is below 80%, so all except JNJ check that mark for me, but JNJ's dividend look a little stretched. To be fair, I think all 3 can sustain dividend payments going forward, because of the size, track record, and well-known brands all 3 companies represent. Fourth is PE ratio, which is price per share divided by earnings per share. This is probably the best known metric out there. But I'm putting it last because I would look at it last to see if a stock underpriced, overpriced, or fairly priced right now, before investing my money. PAYX looks like it's a little overpriced, but it is absolutely normal for software/service company. JNJ's PE ratio, on the other hand, looks too high for me. Why? Each industry has its own average, and discretionary staples like JNJ and Coca-Cola historically sit below 25-30 PE ratio, so JNJ's 33 ratio is above the average. Now, fifth and last step is calculating my own metric of dividend payment and yield on cost in 5 years from now. I'd take current dividend rate, 5-year average increase rate, and project forward, assuming I invested $10,000 in each stock today. Now I see that even though PAYX may start off with low dividend yield, the pace of dividend growth will generate, with all dividends reinvested, a $465 payout in year 5. That is 25% higher compared to JNJ. That's why I love high dividend growers. Thanks for watching. Hope you enjoyed these 5 metrics. Let's ramp up our investments together, and as always, let the compounding force be with you.